Welcome to The Buy-In. My name is Trent Cripps, Director of Property Strategy at Sevenfold Property Group, and I'm also a long-time avid property investor myself. My co-host, Simon Podger, is Director of Lending for our sister company, Your Future Strategy. Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode. Today, I think it's very topical. Recently, the government announced or brought forward the first home buyers deposit scheme, 5% deposit scheme, Simon, and that kicked off on October the 1st, and I think we should have a bit of a chat about that today. What do you think?
Yeah, it's very topical at the moment. A lot of people have got a lot of opinions on it. It's good, it's bad, it's whatever sort of thing. Well, let's go through it first, what it is. I think that's a bit important because it has actually been around for quite some time, back introduced in like January 2020, and it was quite a good scheme back then, but obviously house prices sort of accelerated during COVID and stuff like that, and sort of made it a bit mothballed just because of that fact sort of thing. So what is it? It's a scheme where you can go to a participant lender, for example, NAB, CBA, Auswide Bank. There's lots of they've gone to a lot of the small lenders as well, which is quite good. And you can borrow up to 95% of the property's value without needing to use mortgage insurance, so saving on that fee and stuff like that, which is quite good. The mechanics behind it, how it works, is the government actually provides the lender a guarantee for 15%. So when they actually go and, I won't bore people in the details of the mechanics later on, but when they actually go and sell those loans and package them up, it looks quite attractive to an investor because they've got this government-backed guarantee, which essentially brings the LVR down to 80% when they're looking at, should I buy this pool of mortgages or not? So
no lender's mortgage insurance?
No lender's mortgage insurance, but even better because a government-backed guarantee is, safe as houses sort of thing. If the government's going to renege on their promise, then we're all in trouble.
Pardon the pun.
So, yeah, so that's how it works. So you go find a participant lender. You can borrow up to 95%. Back when it first came out, there was a lot of other restrictions. So they had an income cap. And that was based on your previous tax assessment, taxable income, which was on your notice of assessment when you did your tax. And quite funny, there was a few instances when we were doing these early on where I had people that came back, especially with COVID, that came back from overseas and never had to do a notice of assessment. So one of them was no assessment required. So that was, even though he was earning quite big money, that was the tick in the box. So long as that was under, then it didn't matter what your current income was. So,
wow.
And you had funny instances where people would meet that tick in the box, but then get a bonus or a pay rise or something, maybe not as dramatic, but tip over the scales, so it didn't matter. Anyway, so it had an income cap. There was a property price cap as well that they had in there. And there was only a number of scheme places that were available as well. So, and if you can remember way back when the governments were really, especially over in WA, they were handing out all these grants and stuff like that, especially if you built a property on top of the home, I can't remember what all the names are now, home builder scheme and stuff like that. WA had their own one as well.
We've seen a few, yep.
It was, you're getting to the stage where it was nearly like $50,000, before you even put any of your own sort of stuff in at one stage.
Yeah.
But anyway, so they had those. You could use any of those schemes as well, sort of thing, plus these places. So my point with the places is they got released at the start of the financial year, and they were quickly scooped up, and what had happened was people would go through the process of getting their finance, and the scheme places that they wouldn't be able to get finance, and then that scheme place would then pop up, and you'd put people on waiting lists and stuff like that. So it was a bit of a convoluted process, let me put it that way, sort of thing, because the people were fighting hand over fist. And one of the other the problems with that, having the scheme places with, you might have a client which would fit, let's just say CBA, for example, because they had maybe good policies with regards to self-employed, but they wouldn't have any scheme places left. and then you had another lender, a smaller lender, which wouldn't have that favourable credit policy, and you couldn't put them with it, even though they had a scheme place. So it was quite frustrating that you got those sort of instances that sort of kicked off, sort of thing as well. So coming back to what we were saying about how the scheme sort of got mothballed, it really sort of got mothballed because of the property prices escalated quite quickly around that time, and they only updated from the introduction of January 2020, they only redid the property price caps in July 22. So that's a pretty big gap there.
Yeah, the horse would have bolted a bit.
Yeah, and now here we are in 2025, and this is when the next time they've done them, sort of thing.
Yeah.
So, I thought it was a good scheme at the start. You could see the principles and stuff like that. A lot of our clients used it, which was great. Got them on their foot on the door, which was excellent. Off they went, sort of thing. So, so the government's changed the scheme now, which is great. So they've removed the income cap. So there's none of that anymore. So whatever you earn, that's whatever. It doesn't matter. There's no, it's unlimited scheme places, so that instance is where you can go to pretty much any of the scheme participant lenders to get a loan, which is great, and the property price caps have been increased as well. So you're talking about, like in Sydney's 1.5, Queensland Metro, so Gold Coast, for example, is $1 million, Perth is 850,000. So getting a bit more realistic. I know that that's still hard to find. I'm not going to lie or anything like that, but considering it is your first home as well, it doesn't have to be this is it, set and forget for the next 40 years sort of thing. And if you are a first home buyer, it's always your most difficult one to do. So with these changes, the application process is a lot more smoother. There's no fighting over the places like I was saying before. You just fill out an extra form essentially, and to go through the normal application process, which is really good. So so that's the scheme in sort of a nutshell.
And of course, it goes without saying, there's eligibility requirements in and around age. You need to be an Australian citizen or a permanent resident, over 18, of course.
Yeah.
One of the little known facts is that we because it's labelled the 5% deposit scheme.
Yeah.
There is actually a 2% for a single applicant, or a single parent.
Yeah.
Sorry, I should say.
Yeah.
Which is important to know, because I guess a lot of single parents probably feel like their opportunities past them. So
and so a couple of those points as well, good points to raise, Trent, is so they've got the single parent one, which is instead of 5, it's down to 2% that you only need, which is really good. And you don't have to be a true first home buyer. You just have owned a property within the last 10 years as well. So if you have owned before, that's okay, as long as you've got that gap there, which is quite good as well. So it's in terms of a scheme itself, I like the simplicity. It's easy for people to understand. They know what they've got to do. They know they've got to save X amount, and they can sort of head towards it and stuff like that. There's other ones out there, which we might talk about later on. The first home super saver scheme, but that's a lot more complicated. And there's more other implications to that as well. So, whereas this one, it's pretty simple. You meet those criteria, and you're done and dusted.
Yeah, look, I think it's certainly a positive. How long it remains a positive is certainly one of the things that I've got a lot of concern around, because albeit they've done the right thing and raised the caps, the way property market's performing and the way prices are going, I don't know how long those caps are going to be relevant. Of course, there's always opportunities within those caps. It comes down to compromise. I think part of the challenge is, we're a country that over 95% of the population live near a capital city or on the coastline. And unfortunately, that's where property prices are booming, most predominantly. So regionally, I think this opens up a lot of opportunity for a longer period of time for a lot of people. But whether people are prepared to move regionally to take advantage of it is another question.
Yeah, definitely. And if I can just come back as well, there's a couple other good points I forgot to mention. That the interest rate that you usually get as well is based on 80%. Once that government back in the guarantee has been taken into account, sort of thing, rather than actually your true LVR that you're borrowing. So you usually get a pretty good competitive rate, which is quite good to get as well. And you can still refinance to another participant lender while your LVR is still high as well. So if the property price hasn't gone up, as much as you'd like, and it's like, let's say 90%, it's gone up a little bit, and you're currently with Auswide, who's a participant lender, and NAB come up with a really good offer, you've been on a loan for 2 years, the interest rate's becoming uncompetitive, you can switch across, as long as you're still meeting, like, it's still your principal place of residence and all that stuff, your owner occupier. Whereas in comparison to lender's mortgage insurance, if you did that, you'd have to pay LMI again, the whole hog, So, I understand that the ramifications of this scheme of pushing up prices and stuff like that, possibly in the future, but if I can come back to it, because I've discussed it with friends and family, because again, it's so topical. It was never designed to address house prices,
No.
It was about trying to get people onto their foot in the door, because housing is quite important, to have. It's been proven, sort of thing, over the long run. And, you just hope that the government's addressing it. Okay, we've done this, great. So hopefully the government's addressing other issues like supply, for example, and making it easier for supply to come on board and addressing house prices that way, because that's pretty much what I'd be aiming to do, sort of thing. So not just this like, well, that's done, let's move on from here, sort of thing. So yeah.
Let's just take a slight sidestep. I'm curious, Simon, how did you get into your first property, and what was your sort of strategy in around getting into your first property?
Yeah, we have this chat all the time that your first one's always your hardest, and it just seems like whatever the goalposts of why it's so hard just change over time, sort of thing. So for me, back when I purchased mine, it would be they were very strict about the genuine savings requirement, saving X amount over 3 months. Now that's sort of changed a lot now, so you can sort of show, you can still show that to qualify at high LVRs, or you can show your rental history, and some lenders don't even want that anymore, sort of thing. They just want to make sure if you got the money, great, off you go. They've come to the fact that if you're paying X amount of rent already, that's probably maybe sometimes higher than your mortgage, then you probably should be okay. So come back to your question. Yeah, so for me it was the saving the 5% over 3 months, and then meeting probably to a lesser extent the serviceability requirements back then, to meeting those hurdles. I think that was the toughest one, sort of thing. The property prices weren't as high, so that probably wasn't a hindrance. Whereas when I look now, I think that's, as I say, the goalpost of why it's difficult, it's changing. It's probably the where the house prices are, and then to a second degree, probably the serviceability and the bank requirements now have been a bit more stringent. So,
yeah, I mean, for me, it was an interesting time because it was in my early 20s. Don't want to give away my age on this, but it was in my early 20s, and my partner and I, my girlfriend and I, my now wife, saved for a solid 18 months, and we stopped travelling and, possibly pulled the belt in a little bit, and no avo on toast and those sorts of things. But we saved pretty hard for 18 months straight to get our deposit, and got a small little bit of help from the father-in-law to take my now wife off his hands. But most importantly, we actually just got on the ladder. We just chose to get into a location that was not our most desirable location, of course. It's your first property. You've got to sacrifice, you've got to compromise. And so we were in Sydney, and we lived 45 kilometres from the city. My wife worked in the city, and we just sucked it up, basically. Not really where I wanted to be, but it was just a matter of getting in. And I think that's a really good way that people have got to think about starting, because it's just about getting on the ladder and getting in. And I know you need to have good proximity to friends, family, and jobs and things like that. But sometimes you've just got to not want to be in your most desirable suburb. You just got to just take it as an entry point. And as you quite rightly said, the hardest property to get in is your first. But we were both in PAYG, so fortunately, and albeit not high-paying jobs, but fortunately, the lenders saw that as nice, stable income and a good way to get in. So, but we had the full 20% deposit, but it's just a matter of using it as a springing board. So.
Yeah, and interesting. Coming back to the scheme as well, is it's not restricted to like let's say a couple. Two friends can come together, as long as you're both gonna live there. Then that can work as well, sort of thing. So.
Yeah, I want to talk a little bit about, because obviously this scheme is designed to help people get into property, because it's very topical about housing affordability and how tough it is to get into the market. So. This is the government's way of, helping some people. It's not going to suit all people. And it all seems good, but I think there's still certainly a lot to consider around how you service the debt once you're in, because, it's great that you can get in on a smaller deposit.
Yeah.
But we want to make sure that, everyone's going in eyes wide open, that you're not going to run into mortgage stress.
Yeah, definitely. And just on this as well, you don't have to do the 95%. Like if you want to do 90, you can do 90 instead if you've got more savings and you don't want to borrow as much as that sort of thing as well. So, and the lenders will actually look at your position and say, well, listen, you're holding too much cash post-purchase. We want you to use more of this. If you're trying to do 95%, they'll probably... If you've got excess cash, they'll let you have a bit, for obviously a buffer and stuff like that, buy furniture and things, but they won't let you have like $50,000 left over sort of thing. They want you to use that. It's not really what the scheme's designed to leverage people up sort of thing. But yeah, so coming back to your point, like anything, the bank will say you can borrow X, but are you comfortable in borrowing that? And you've got to sit down and work your own budget and make sure that, I can afford this and still live a happy life sort of thing. There's no point being miserable under mortgage stress. That's the worst position you can be in sort of thing. So I think that's really important, that you get that really, you know your budget and you know your limits sort of thing, and then work backwards from there, from what's available. And that comes back to that it may not be the top end of town sort of thing that you can do sort of thing, but again, just keep it in perspective that it's not going to be your house that you're going to live in there for the rest of your life. It's probably just going to be your stepping stone. So,
yeah, absolutely. And look, there's other ways around it. I mean, I know that this scheme is not like, as you said before, if you haven't been or owned a property for 10 years, this is not necessarily just for young people, first home buyers. It's, potentially people getting back on their feet in their middle stages of life. But there's certainly some different ways around it. If you do want to get in and you do feel that taking on the entire mortgage repayment yourself is going to be a stretch, then to your point, you can share it with a friend or a partner or whoever it may be, or possibly you could rent out a room to sort of support the mortgage repayments on a monthly basis. But it's just about finding a way to get in and get going.
Yeah, definitely. And the only thing I'd say that is just be careful with some of the other arrangements with, stamp duty concessions and stuff like that, because that can actually, if you rent out a room and lease out a part of the property, you can get into strife there and have to pay back stamp duty concessions and things of that nature. So just make sure you cross everything on that front, that you're outside of those requirements. So
just to throw you a tougher question, just in case we've got anyone listening that's self-employed or not PAYG, is there any additional considerations in relation to this?
Not really. It just comes back to, like I was saying in that original example, is, a lot of lenders have very different policies for self-employed. It's become a lot easier for self-employed to get mortgages, thankfully. It used to be, they all used to ask for like 2 years of, tax returns and financials, and that was sort of like the stock standard for every lender sort of thing. And now that's changed quite dramatically. So some of them are only asking for the latest year financials, and that's it. Some of them are looking, if you run a company and then you pay yourself a wage, then they may just consider looking at the wage that you're paying yourself, for example, and if that works on the calcs, then that's great, sort of thing. So to come back to it, it just really depends on finding that favourable lender that's going to work for your circumstance, and that's why the removing those scheme limits, spots, has made it a lot easier for people to find the right home, and that was my other frustration is, even if you sort of had to settle for what was left when there were scheme places as well. So it was like, oh, well, this is the only one I could get. And like I was saying, most lenders will do the rate at 80%. Some of them will still do the rate at the higher 95% rate. So if you were back in the day ended up going, oh, well, I have to settle for this guy and get a really uncompetitive rate, and product and stuff like that. So yeah, sort of coming back, just it's a lot easier to find a good home now that fits the bill for those sort of circumstances, which is good.
Now, at the time we're talking, this has really only been, I guess, this new and improved scheme has only been around for 3 or 4 weeks now. And in my role, I talk to a lot of agents, real estate agents. I've got a really good handle of what's happening on at the ground level. And, let's take a market like Perth, for example, where the cap is $850,000. That has significantly increased the activity up to that level. So we know that, albeit we haven't seen any stats yet because it's too early, the feeling is that it's working and people are utilising the scheme. The challenge then, like I said earlier, is, when you all of a sudden create increased demand, and the supply isn't there to meet that demand, naturally prices are going to go up.
Yeah.
So what is sub 850k today in that market? I don't see it being in that market at sub 850k for very long. In markets like Perth and Brisbane, generally, and I don't really want to generalise, but generally both those capital cities have achieved double-digit growth in the last 12 months. So if something's sitting at $800,000 today and it maintains double-digit growth, it's not going to be a year before it's going to be outside the cap. It's probably going to be 6 months. So that creates a real challenge as well, because for those people that aren't ready and willing and able to jump on this now, the danger is there's further possibility that they're going to get even more priced out of the market.
I mean, my sort of understanding is it's going to be a bit of a sugar rush, that the prices will escalate, but then the demand will then slowly come back on, as those have gone to the thing, and so it might peter out. That's my sort of theory anyway. I just think, coming back to house prices, that we're just not building enough.
That's right.
So
that's right.
Until that's sorted, that house prices are going in only one direction. It's the rate of growth which probably alters, in those, and then obviously then you got then by suburb, and then there's supply and demand and infrastructure and jobs and things like that has the impacts to what's happening with the specific prices down to the street level sort of thing. But at the end of the day, we're just not building enough houses, so that the government really needs to address that to try and slow the rate of growth. I think that's the best we can hope for. I don't think that there's no political will or political pressure to lower house prices, really.
That's right.
No one's if that was your slogan, vote for me and I'll lower prices. You're not going to get any votes.
That's right.
Who's going to do that? The person not going to vote for the politicians are going to put that out there. So I think the best we can hope for is just slowing the rate of growth. So.
No, I couldn't agree more. And I can't help but feel that this is just a political election promise, which is a band-aid solution to a much, much, much bigger problem.
Yeah, and I mean, this is where I'm coming back to the point, saying everyone's it's terrible, blah, blah, blah. And I'm like, it was never designed to fix house prices.
That's right.
It's like saying, if you're looking like a healthcare policy, that we're going to increase the amount of diagnostics, services, and then saying, well, how's that going to impact, waiting times? Well, it's not. It was never designed for that, know. And that's why I hope the government will do other things to address house prices, which hopefully on the supply side, to try and help that, that slow that rate of growth down, sort of thing.
Yeah, it's kind of almost like it's going there anyway. So jump into this window while you can. Otherwise, unfortunately, you'll be left behind.
It's not my opinion, but I'm just realistic looking at what's happening, and I'm going, well, I just can't see it changing. Unless we build more houses, and we've got to catch up anyway.
That's
let
right.
alone build each year, then the house prices are going to go up,
Yeah.
And in the medium to long run, so.
Absolutely. And don't want to get too far off track, but we're also, victims of this hyperinflation cycle that we've been through because, we've seen significant growth, significant increase in build prices and materials and labour and everything basically involved in. So
yeah.
It's a challenging time, but anyway, getting back to this, I think I think the positives are certainly that it's been unlimited places, more lenders been on board, higher caps, so it's a real opportunity for someone that's ready or close to being ready to get into the property market. This could be your big opportunity.
Yeah, definitely. And as I said, like we have clients that have used it, let's say Mark 1 version, and did very well out of it, which was great, and got them on the ladder. Because I think it's, when you look at taxation and, old age pension and stuff like that, it is favoured to someone owning their own home, So I think it is quite important that you try and make that a priority as best you can. So use any tool you can to get in. So
yeah, absolutely. If anyone has any questions or inquiries, feel free to reach out to us at Sevenfold Property and Your Future Strategy on the lending side, and we'll certainly be more than happy to guide you and direct you in the right direction.
Please note, all the opinions and information in this podcast are of general nature only and should not be relied upon as advice. You should always seek professional guidance at all times before making any investment decisions. Please see the link at the bottom of each episode.